Well, good morning, everyone. Thank you for joining us today over your lunch hour. Would like to welcome you to our presentation of the last of our webinars for 2020. Today we'll be talking about lending, and we've got a great special guest for us to talk about the impacts that COVID-19 has created in lending for small businesses. Before we do that, I'd like to real quickly give an overview, if you wouldn't mind going next slide. I'd like to give you a quick overview of the SBDC and what we do for those of you who may not be aware of what all we do. But our mission is to advance the economic development in South Carolina by helping entrepreneurs grow their businesses. And we serve both established businesses and new businesses, entrepreneurs looking to start new businesses across every industry segment. We're part of a nationwide SBDC network, but we are the South Carolina SBDC. And what we do for clients is we help with business plans. We help people build financial models to help with their business plans to go and approach lenders for loans. We also help with marketing. We help with marketing plans and strategies. We do strategic planning. We help with sales growth strategies. We can help with importing and exporting programs. We provide help with government contracting and certifications. And we also help with product commercialization for folks who have home-based businesses and are looking to build a business and take it to retail stores, and we help with that. We're here to help right now. These are trying times, and we've pivoted a bit right now by offering training programs like this. We've been heavily involved with the CARES Act, with the funding programs, not only the federal program, but the South Carolina program, which just ended last night. We're helping with marketing strategies. We're helping a lot of clients just to kickstart their businesses again, to help rebuild their customer loyalty, and helping people with financial modeling to adjust the fact that you have lower demand. And a lot of times, if you're dealing with certain types of businesses, lower capacity. And training like this to quite honestly help you navigate during what we're calling the new normal. It's anything but normal. Next slide, please. By virtue of you signing up today, you are an SBDC client. So if you're an existing business, please reach out to us at winthropregionalsbdc@gmail.com, and we'll be glad to help you, bring you in for one-on-one counseling. If you're thinking about starting a business, you can go to that same place, and sign up and actually ask us and let us know that you're a new business, because we have a different process where we'd send you to our startup workshop before we bring you in for one-on-one counseling. And there's the phone number for our office also. Okay, so I want to turn this over to our guest speaker today, and we're really excited to have Joanne Faulkner with us. Joanne is a business banker and VP at First Citizens. And a little bit about Joanne. She is an active member in the Rock Hill community. She's on the executive committee for Rock Hill Economic Development Corporation, and she also sits on the entrepreneurship committee. She graduated cum laude from the University of South Carolina with a Bachelor of Science degree in Finance and Marketing, and has over 11 years of experience in commercial lending. She's an active member in both the Rock Hill and York County communities, and also graduated from the Leadership York County group, where she was on the Finance Committee as the chairperson. And she also is active in her spare time with the Dorothy Day Soup Kitchen Board. And she has been at First Citizens since 2015. So I'm going to turn it over to Joanne to walk you through today's presentation. Thanks, Joanne.
Thank you, Todd. So good morning. We are going to kind of go at whatever pace it kind of dictates for you guys. So if you have any questions, please put it in the chat. Todd will read the question, and we'll pause between slides in case you have kind of the benefit of small group. In case you have any questions, we can slow down and talk a little bit further about some certain topics. So to jump into it. Oh. Okay. So there's the 5 C's for credit. These are the 5 things every bank is looking at. They're looking at your capacity. So that's your cash flow coverage. They're looking at your capital, how much money you have down, your access to other capital, your liquidity. They're going to look at collateral. So that's what secures the loan. And in the event of a default, that's what the lender is entitled to. Character, that demonstrates your willingness to repay the loan. So that's where your credit report comes in. They're going to look at your credit history and determine based on how you've performed on things you promised to pay. That shows your character and shows your willingness to repay on future loans. And then the last of the 5 C's is conditions. So that's your rate, your fee, your terms, your loan to value. And those vary depending on what kind of loan you're trying to do, your purpose of your loan, and also the collateral. So then there's the last C that has come about this year, and that's the COVID impact. So there's more things that banks are going to be asking for these days. We're going to ask for year-to-date financials with prior year for comparison. We're going to ask about closures, furloughs, projected revenue, expense reduction, if you receive PPP funds, if you receive EIDL funds, and then sources of capital. So in case of another shutdown, what do you have to fall back on? So that could be business line of credit, that could be you have home equity lines, that could be liquidity, which is just cash in the bank. So these are things that we're now asking, and I know if some of you went through the Great Recession, it'll feel a little similar to that. What did you do to change? What are you going to do going forward? What kind of safety nets do you have? It just caused banks to ask some more questions. If you want to pause for a second, does anyone have any questions so far? We're going to go more into depth on all of them.
Don't see any questions yet, Joanne.
Okay. So moving on. So capacity. When we look at capacity, we look at cash flow coverage. So here's just an example of, we look at historical financials. We look at 3 years historical. So this is in a manufacturing company who's applying for a new piece of equipment. They're putting, it's $100,000 for the cost. They're putting 20 down. They want to finance 80,000. So we just plugged in a rate of 6%. That's a lot higher than rates are today, but it's just good for math's sake. And they already have other equipment loans that are in there. So we look at their net income. We add back things that are non-cash items. So depreciation is great for accounting, but it doesn't actually cost you money. So we add depreciation back, and non-cash, if there's non-recurring items, so if you paid your parking lot this year, well, you're not paying it every year. So certain one-time non-recurring items can be added back. I would advise if you have if something big happens during the year, that you just keep track of them, because bankers are going to ask, hey, something's changed. Can you please explain the change? Your job as the business owner is to know what the changes are and why they happened. We add back interest, and then so it gets to that 80,000 for cash flow, and we compare it to the debt service. So in this example, 3.12 times cash flow coverage, that's super strong. We're good. We're moving on. So this is kind of how, when I say you need to know what's recurring, here's an example. So we look, you see it's negative cash flow, substantially negative cash flow. And if you look at it, you'd say, there's no way they had the ability to pay their loan back. But the answer is maybe, because sometimes there's one-time events that occur there. Could be the salary to the owner, the officer's compensation is kind of way out of whack, huge dividends, that kind of thing. So there's things you don't know. So the formulas are important, but the story behind it is why you have bankers. They need to know the story behind it. So typically, you have a cash flow coverage target of 1.2 or greater. But if it's not there, we need to understand why. You need to understand your financials. And a good example is if it moves, be prepared to explain it. And then also, like I said, keep a list of one-time non-recurring expenses. So the next part is about capacity. So anytime you do a startup, you're going to have to do a business plan. The SBDC is wonderful to help you with that. They're going to help you do 3 years projections and make sure there's a monthly breakdown of the projections. The reason for that, so sometimes people say, well, hey, I've been in this industry, so I'm a client who's an engineer for somebody else forever, and now he wanted to do it by himself. He has all the industry knowledge. He's ready to be his own business owner. And part of creating projections helped him figure out how much money he needed to get to profitable. So for example, when a business starts, it's not going to be making money day one. What's the gap until profitability? And then making sure you have that with some cushion. In his example, he didn't use financing, but you need to understand where that number came from. A lot of times people will come to us and say, I need this amount because that's what I need as a salary for a year. That's not how it works. So that's where breaking down the sources and uses, and again, talking to the SBDC to help with those projections. They have great models for it. So the next one is your capital or collateral, so your secondary payment sources. I will tell you, I have a lot of times where people don't have cash flow, but they say, I have this thing and it's worth money. As banks, we don't want to take your piece of collateral. We have it in case things go south, but we need to prove that you can pay it, and that's where the capacity is looked at. But in case of default, we can't, personal guarantees, collateral, outside income. So a lot of times people will start a business or they're running a business and their spouse works somewhere else. That's an outside income source. And so that obviously will be considered. Other assets. So one of the things I'll tell you is a lot of people come to us for small business loans. They have equity in their house. They have the capacity to get a home equity line, which can help them have the flexibility that they want and they need. So that's using other assets. It's using your house, and they can lend the money of their own business, and that gives them the working capital that they need without going through the process with us. But still, you want to know with your business plan, look at your projections, what's that gap look like? So the next part, let's go further into personal guarantees. If someone owns 20% or more of the company, most banks are going to require that person to guarantee, and they want to make sure they have at least 51% ownership. That varies. It could be 70%, but they need to know who the owners are. And if there's a lot of people who own just a little bit, they're going to want to make sure whoever is involved in the day-to-day operations is on the loan somewhere. So the outside income, that's when we look at global cash flow coverage. So some banks look at a business specific, some look at global. So with closely held businesses, the person who owns the company is very tied into the cash flow of the company, obviously. And so that's why that global number can make a difference. So back to that manufacturing example, if you put it globally, they could have great cash flow, and therefore, it's a one-time dividend distribution, or they bought out a partner or something. So there's some event that we can explain, and then globally the cash flow still works. Your personal guarantee is saying if the company doesn't pay, I will personally pay. So people, when they sign personal guarantees, don't always understand you're making a promise that they'll pay. Even if the company is no longer in operation, you still made that promise. So it's not like the debt just goes away. And also, lenders don't have to go after collateral first. So if you partner with somebody and you buy a building and you have bank loan on it, and the loan goes south, and you're a high earner, and the other person that you're in is just your college best friend, they don't really make a lot of money, the bank doesn't have to go after you both equally. They can just go straight to the person who can pay it. So partnerships are very important to understand who you're in business with. And then also we look at the personal credit history of the owner, because that typically how you handle your personal financials is a good indicator of how you'll handle your business's financials. So then we go to capital. So almost never, okay, never say never, but almost never 100% financing is an option. With the SBA, you can reduce the amount of money that has to be put down, but that doesn't mean 100%. Except sometimes on new equipment, banks will go 100%. And after your down payment, if there is a down payment requirement, when we talk about liquidity, that's cash you have in case of emergency. It's kind of a good way to think about it. If after your down payment, it wipes out your liquidity completely, that's another thing a bank will take into consideration, because what's your fallback? So if you take away your liquidity, you might not have working capital, you might not be able to handle any unexpected costs. So a bank wants you to have skin in the game, very important. So the next part is about collateral. These ranges vary widely, 80 to 85% on owner occupied. But if it's a special purpose building, it could be as low as 75% loan to value. So that means you're putting down 25% in an example versus 85% loan to value, you're putting 15% down. New equipment, I put up to 100% because that's true. And used equipment, it really depends. You could get 100% on used equipment. It just depends on what it is. If it's too used, too old, you might not be able to get anything against it. So going back to personal credit score, I think this line is perfect. A good personal credit score won't qualify you for a business loan. However, a bad one will definitely disqualify you. So we have times where the cash flow looks amazing, but the personal credit looks horrible. And it's really hard to get those kind of clients approved because their personal credit history doesn't show that they're good stewards of their funds. If you have an explanation, certain things happen. They have explanations. We're willing to listen to them. So if you have any resolution, like proof of resolution or status of the matter, sometimes, especially medical claims are the worst. They kind of get put out there. You've never gotten a bill for it. I mean, there's explanations and that we'll look at, but it's just important for you to know, because if you don't know, it's certainly not something we would know. So the next two about understanding your credit. This is really important. How do you get and keep a good credit score? Pay your stuff on time, every time. I mean, that's kind of a no-brainer, but don't get close to your credit limit. So this is kind of the tricky one. You don't want to have 20 credit cards, but you don't want to have one credit card that's maxed out. That can affect you. So don't get close to your credit limit. If you have any cards that have been open for a really long time, even if you pay it off, don't close it. Leave it open. And only apply for, see that part, only apply for credit you need. Well, if you have one card, it's maxed. But try not to have 20 cards out there, all with limits on it. And then fact check your credit report. So the next part I'm going to show you, this is annualcreditreport.com. So this is the next link. You can, over here, pull your credit report. You can pull it, if you want your score, you have to pay, but if you're just doing it to get the information, you can pull each of them. There's 3 different credit reporting agencies. The way I say it is I would pull Equifax now, look at it, see if you see any errors. If you do, dispute them. Not when a bank tells you it's wrong. Go dispute them now because they're affecting your credit. And then I would pull, in 3 months, I'd pull Experian. Look at that. See if there's anything on there. Make sure if there's something bad on that it comes off. And then 3 more months, pull TransUnion, because you can pull one of each once in a 12-month cycle. So I would definitely recommend that. A lot of people who haven't been lending frequently don't really watch their credit report, and there's ways to lock them down. I would lock them down, really recommend it. Fraud is prevalent everywhere, and so it's just a good idea to protect yourself. So this next part is conditions. So interest rates are risk driven. So if it's unsecured, your interest rate is going to be higher. If it's secured, it's going to be lower. And then collateral does drive the repayment terms. So if you have real estate, it could be anywhere from 15, 25 years is kind of a stretch. Typically, most would be longer than 20 years, but if you get certain SBA programs, you can get to 25 years. And then on equipment, it depends on the useful life. So 3 to 10 years, I would say on average it's 5 years. Just think like a vehicle loan. That's really common. And then unsecured working capital, 3 to 5 years. I would say it's usually shorter than that. It's usually could be as short as 12 months if it's a revolving line of credit. Okay, so back to COVID. It has slowed down tremendously the banking process. So there's a lot of reasons for that. So think about also banks have PPP loans that are in the process of, people are in different parts of the process that they want to seek forgiveness. Once the bank gets the application, banks have a certain time period that they have to turn around and approve it. And so during that time period, though, they're getting back with the client and asking for this document and that document. Very documentation heavy, as you know. So that's a big impact. And that is a team effort. That's not just one person looking at it. That is a huge team effort for the bank. So that affects timing. So I would heavily recommend talk to the SBDC, get all your documents together, and then get to a bank. And don't sign anything. So for example, if you're thinking about purchasing a franchise, do not sign any franchise agreements until you know that you are approved by a bank or close to being approved by a bank. Sometimes people will sign things and say, oh my gosh, well, I have to open in the next 30 days. That's not going to happen. So just slow down and I'll help you speed up later on. So the importance of post-transaction liquidity, that's the safety net that we keep talking about. If you don't have capital to fall back on, and let's say there's another shutdown, your rent doesn't stop. You might have employees that you choose to keep paying. Your taxes don't stop. So post-transaction liquidity is more and more important, especially when markets are tough. Now, that's not everyone's markets aren't tough. There's a lot of clients who are really thriving in this environment. They've made some great changes that they're going to continue on with. They've saved them significant amounts of money, which is great. And going forward in this new model that they have, they're going to be even more profitable, which is wonderful. A lot of clients who have online business or online capabilities, they've really thrived in this environment. But so then that gets to tightening of credit. There are certain industries that have been heavily impacted by COVID. And so there are industries that banks are a little more hesitant to lend on. I would say overall from multiple banks, we've heard people want to buy a retail shopping center. If you just look at store closures across the country, it's huge. And it's not just the little guys, it's the big guys too. So there's a lot of hesitation for non-owner occupied buildings. But if you have all your information together, you have all your historical information, you have your business planning, you know your stuff, we're still doing loans. I've had one of the best business years ever this year, which has been phenomenal. People know that interest rates are low, so they want to take advantage of it. So it's still been a really great banking environment, but it does take longer. Even those deals have taken longer. So just know that it's going to take longer. And then the explanation of the COVID impact. We're going to ask you, how has this impacted your business? And just say, meh, hasn't. It has in some way. And it could be, hey, during furlough, there were some people who chose not to come back, and it was the best thing that ever happened to us. I mean, it could be that's happened with a lot of people. Or it could be we didn't have a website. We realized that was a huge mistake. We got our website up. We've added e-commerce, and it's just transformed our business. There's a lot of ways that it's affected everyone, not all negative, some good. So that is really, really, really important. So here is kind of lending 101, lending terminology. Amortization and balloons. These are really important. People will come to me and say, hey, I want a 30-year mortgage on my owner-occupied building. Not going to happen. So on a business loan, most business loans have some kind of balloon and which is different from the amortization. So your amortization is how many years your payment's calculated on, and your balloon is when the loan technically matures. So for example, very common balloon is a 5-year balloon on a 20-year AM. So it means your payment's over 20 years, but your rate is only fixed for 5 years. At the end of the 5 years is the renegotiation. It's another appraisal. And if you don't like your bank, it could be a different bank at that point. Your interest rate is fixed or variable. Variable rates are based on prime. There used to be LIBOR. LIBOR is really being phased out, but it wasn't very common in smaller businesses. Principal is how much you owe. Loan to value is how much you owe relative to the value of the collateral. Prepayment penalty. Most fixed rate loans have some kind of prepayment penalty, typically between 3 and 5 years. Some can be for the life of the loan, and it can be anywhere from 1% to, I think the harshest one I saw was 5%. The terms within the prepayment penalties are different. Some banks will let you pay, for example, we will up to double the payment with no penalty. And other banks say, no, you can only make your payment anything more, there's a penalty. So term sheet is going to spell out the general terms of a loan. It's usually a negotiation point. So the banker will come and talk to you and say, here's your term sheet, here's what we're thinking. It's generally not a commitment. It's not quite there. There's something missing typically. So think of it as like a loan quote. A commitment letter is going to spell absolutely everything. It's going to spell out the need for an appraisal, the need for an environmental, flood certification, title search, UCC. It'll spell out absolutely everything. So I would say typically the commitment letter is more valuable than the term sheet. Not everyone does term sheets, not everyone does commitment letters, but those are the differences between the two. So how do you make a complete loan request package? So this is the biggest thing. People will want a loan and then they won't give us the entire package. So obviously until we have the entire package, we can't do anything. Typically, I would get your 3 years federal tax return. If there's an extension, you shouldn't have an extension now. You should have your tax return. Any K-1, if you own more than 25% of something, be prepared to give the K-1 and the tax return for that. Year to date, we're going to need prior year for comparison. So that's more important now more than ever. It's not a bad idea to break it down by monthly, because then you can show, hey, yeah, we did have this downtick because of COVID, but then we went right back up. So I have a lot of clients who their March and April was bad, maybe even their May, but then their June, July more than made up for it. They're still year to date a little behind, but you can see it was very isolated. So that's important for us to know. Then your business plan, as we talked about. And to go back to the tax return, we'll go down this. And then personal financial statement of the owners, that's your personal balance sheet. And the last part is your personal tax returns for the last 3 years. And the reason for the W-2 need is if you are working somewhere and you're not going to be working there anymore, that W-2 income will not be counted when we're looking at your global cash flow. So I think, we got one more, and then we'll stop for questions. So additional tips, like I told you, business and personal loans are very different. They're not even the same beast. They're not on the same planet. Commercial loans tend to be shorter repayment, and typically have higher interest rates. Loan agreements are additional documents. When you get into bigger loans, you'll have loan agreements that'll spell out things like you have to provide your financials annually. You have to keep a certain cash flow coverage ratio, and sometimes there are negative covenants that say you can't borrow any more money without the bank consenting. So last parts of resources, the SBDC is super important, and the SBA. I think those are really great sources. And then Catawba Regional Development is a great resource. They partner with banks. just like the other two. So I think they're a great resource. And then the South Carolina and the U.S. Department of Commerce, USDA has a business loan program. There's just a bunch of different opportunities, and the South Carolina Community Loan Fund program was another opportunity. So that completes my presentation. Does anybody have any questions?
I don't see anything in chat yet, Joanne, but I want to ask you a question. Sure. A little bit about the 100% as it's related to new equipment. Is that primarily only for existing businesses or startups in terms of not having to put anything down?
That is typically existing businesses.
Okay.
So sometimes for startups, if they've been in the industry, they have outside sources of income. Sometimes you can't go 100% on a startup, but typically existing businesses is more than 100%.
That's helpful. Thank you.
Oh, Phil has his hand raised.
What?
Phil has his hand raised.
Okay. If you have your hand raised, go ahead and unmute yourself, or if you can.
Okay, can you hear me?
Yes. Yeah, we can hear you. Okay. Phil.
I didn't get the link to the webinar until about 20 after. Is this recorded by chance?
It is, so we can send it to you, Phil.
Okay, thank you.
Did you have a question? Okay. Question, is it difficult to get a loan for a startup in this environment?
Yes. No, I'm just kidding. Yes, it's very difficult. If there's no outside source of income, it is very, very difficult. So what we recommend is if you have an existing source of income, so let's say you work a W-2 job, you have some equity in your house, and you're thinking about starting a business. While you have a steady source of income, go get a home equity line. You'll have that for working capital. That can kind of bridge the gap until you can get started, get revenuing. Typically, after 2 years of being in business, it becomes easier to get a loan. It can be sooner than that, but I'd say that's a good rule of thumb. A lot of people, by the time they come to us for a startup, they already have quit their job. They're already dedicating their time to it. That makes it a lot harder.
And for those who do, because I've had a few folks who have been able to get startup loans, what do you see in them that's different from a typical startup? You know, people that are able to get a startup loan, kind of what's the dividing point there between someone who can and can't? What do they do differently than those who aren't successful?
Yeah, I'd say pre-COVID, there were a lot of people with startup loans that we could do. Post-COVID, it's very rare. Outside sources of income, really, really important. Yeah. Collateral based, they're buying a building, they're handling the working capital. They just need the building, they just need equipment. So we have collateral, it's not unsecured. There are examples where we will they have equity in their house, so we can take a lien against their house. So we're fully collateralized, but also none of their cash flow is based on projections at that point. If it's projection based, it's going to be more in the SBA world. And the SBA is very inundated with PPP right now, so they're a lot slower. Tom, you said, what are the different types of SBA loans? There's kind of two main channels, if you will. There's SBA directly through a bank, through the 7A, and then there's SBA through a 504. So that's with a Certified Development Corporation. With the 504, which is more Catawba Regional, a lot of that is real estate, some equipment, but mostly real estate purchases. So you're going through two different entities. But every bank has different programs. Just because the SBA has, I don't even know how many programs, every bank doesn't participate in each kind. So I would say it'd be a better kind of use of time to find a bank that you like and talk to them about what you're trying to do and work with their SBA department what SBA does as well. So when we talked about unsecured loans, typically that 36-month time period, most people need more than 36 months. So if they need more than 36 months, the SBA is going to give them, depending on it, so on a business purchase, for example. So let's say you're buying a business, not starting it up. We go 3 years, or in certain industries, we might be able to get to 5 years. Well, the SBA is going to give you 10. It's going to be a higher rate, but they're going to give you a 10-year fully amortizing loan. It used to be if you get 6, it's getting more rare. So a lot of them are variable, but variable rates are really low right now. So it's not a bad solution at that point.
And going rates on SBA loans right now?
7, 7.5, 8.
Including the fees?
So I'm talking on the variable. On 504 rates are crazy low, but then when you put in the servicing fee, they're probably in the 4s, I would say. Mid 4s, maybe 5, just depending. 504 on a building will let you go to 25 years on that portion. So maybe the bank that's for a 20-year AM, the 504 can be on 25 years, and that can make all the difference in your cash flow.
Any other questions from anybody?
I would just say you don't have to go SBA. I think the SBA is a great program, but that's not the only way to go about it. Talk to a banker, tell them what you're trying to do. Make sure you've saved up that working capital, and make sure you've saved up that safety net, because it's a lot harder to get a loan if you don't have those things. Sometimes people will have 401ks that they liquidate to give them the down payment, but you need a safety net. And the reason for the safety net isn't to be mean or horrible and make it really hard to buy a business. It's to help you with your success rate. You're more likely to be successful if you hit, sometimes a tiny hurdle can take somebody out of business if they don't have a safety net. So it could be their AC needs to be replaced. That's it. You don't want that to take you out of business. Take a little bit more time on the front end, and then that'll help you be successful on the back end.
Excellent. Okay, one last chance for questions, and then we'll let these guys get back to doing what they're doing. Okay, well, Joanne, thank you so much today. This has been great, been very informative, gives us all a good perspective for not only the basics, but also kind of how COVID has changed things. So it helps us a lot, it helps our clients a lot. So we very much appreciate it.
Thanks for having me.
All right.